If you had $100,000 to invest today, would you trust it to Fidelity or BlackRock? Because the answer could mean a multi-million-dollar difference in your future net worth. These two giants are like the Apple and Samsung of investing, massive, strong, and constantly battling for your money. But when you strip away the branding, the glossy marketing, and the finance jargon, which one actually grows your wealth faster? In this video, we're putting them head-to-head in a 7-round investing showdown, comparing fees, performance, risk, total returns, and more. And to make it real, we'll follow a simple case study. If you invest $100,000 into each fund today, how much would you have in 10, 20, and 30 years? Which one builds the bigger future? In fact, by the end, I'll show you how one fund wins more rounds, but the other adds over $3 million in pure returns. When it comes to the world of investing, Fidelity and BlackRock aren't just names, they're empires. Together, they manage trillions of dollars and have a massive influence on how people invest and grow their wealth. But here's the real question. Does their massive size automatically mean better performance for investors like you and me? Or is it just brand power dressed up in a financial suit? To figure that out, we need to speak their language, the basic terms that drive how these funds actually work. Think of it like learning the rules before you step into the ring. There are 4 key ideas that explain how these giants operate and how they make or take money. Assets under management, or AUM. This is basically the scoreboard, the total value of all the money a firm manages. A higher AUM usually means more investor trust, but not always better results. Expense ratio. This is your fund's annual membership fee. It's what the company charges to manage your money. The smaller this fee, the more of your returns you actually keep. Diversification. This is your safety net. Instead of betting everything on one company or one idea, your money is spread across hundreds of businesses, so no single failure can sink your ship. Index fund. This one is the workhorse. It doesn't try to beat the market, it mirrors it, following major benchmarks like the S&P 500 while keeping costs low and results consistent. Once you understand these fundamentals, you'll start to see why BlackRock and Fidelity play the game so differently, and why that difference could make or break your long-term returns. Now, to best decide which one is for you, I'm putting Fidelity and BlackRock head-to-head across 7 categories: fees, strategy, volatility, customer service, and more. We've got the foundation in place, so it's time to meet the players themselves. Because behind every investment firm lies a mindset, and that mindset is what truly determines how your wealth grows. Let's start with BlackRock. If the world of investing were a chessboard, BlackRock would be the grandmaster. Not because it moves the most pieces, but because it controls the board. With over $11 trillion in assets under management, it's one of the most influential forces in global investing. But it didn't start that way. Back in 1988, BlackRock was just a small firm with a simple goal: help institutions manage risk and build steady returns. Fast forward 3 decades and a few major acquisitions later, most notably the game-changing BGI Barclays Global Investors deal in 2009, and BlackRock became the undisputed king of index investing. What really makes it powerful, though, isn't just size, it's data. BlackRock runs on Aladdin, a proprietary AI-driven risk analysis platform that tracks trillions in global investments in real time. Think of it as the Jarvis of finance, scanning markets, measuring volatility, and adjusting strategies faster than any human advisor could. But size and technology cut both ways. On one hand, BlackRock's dominance gives it immense stability and influence. On the other hand, its massive scale can sometimes make it less agile, slower to pivot compared to nimbler firms. So while BlackRock is known for its stability, scale, and data-driven strategy, it's built with one clear mindset: play the long game. For investors who value structure, consistency, and global influence, that approach can be incredibly appealing. Now let's look at the other side, a firm that built its empire not on size but on innovation and accessibility. Fidelity. Founded in 1946 by Edward C. Johnson II, Fidelity started with a simple idea: put the investor first. That principle built an investing culture that millions trust today. While many firms were serving only the elite, Fidelity opened its gates to everyone. They brought investing to the masses with tools, technology, and transparency that were decades ahead of their time. Over the years, Fidelity has become a symbol of innovation, from zero-commission trading to real-time digital access and intuitive digital platforms. They've made it possible for anyone to invest, not just Wall Street professionals. Their biggest strength, though, is service. Fidelity's customer-first approach means they don't just manage money, they build relationships. With millions of clients, their focus on personal guidance and trust has become a true differentiator. But beneath that customer-friendly surface also lies a sophisticated investment engine. Fidelity isn't afraid to go active, handpicking stocks, leaning on research, and blending technology with human insight. And now that you've met both contenders, it's time to see how they perform when the numbers start talking. Every investor knows that performance depends on the tools you choose, and in this first category, I'm looking at what both giants, BlackRock and Fidelity, bring to the table. BlackRock offers one of the most extensive product ranges in the entire investing world. Its iShares ETFs are iconic, low-cost, efficient, and built to track almost every market you can think of. They become the foundation of retirement portfolios around the world. But there's more to BlackRock than just ETFs. The company runs massive stock and bond funds, manages real estate and infrastructure portfolios, and even advises governments and institutions. Everything they do is powered by data, advanced analytics, risk models, and algorithm-driven insights. Their belief is simple: numbers make better decisions than emotions. That focus on data gives BlackRock its precision and power. Fidelity, on the other hand, takes a completely different route. It doesn't overwhelm you with scale. It empowers you with choice. Their ecosystem feels personal, from mutual funds and ETFs to retirement accounts, managed portfolios, and zero-fee funds that made the industry gasp when they launched. What makes Fidelity unique is how it merges accessibility with sophistication. You can start with just a few bucks, get human guidance through their advisory tiers, and grow into a full-scale wealth client all under one roof. Their user experience is smooth, their platform design intuitive, and their service structure is built around everyday investors, not institutions. Both offer incredible products, but in this category, Fidelity takes the win. It blends variety, innovation, and simplicity in a way that makes investing feel empowering, like Wall Street tools made for everyday investors. So the score right now is Fidelity 1, BlackRock 0. And now that I've compared their products, it's time to see how they perform where it really counts. The S&P 500 Showdown. The S&P 500 is the ultimate benchmark, a snapshot of America's 500 largest companies. It's basically the heartbeat of the U.S. economy. When this index moves, everything else follows. And in this category, I'm comparing two heavyweights, the Fidelity 500 Index Fund and the iShares S&P 500 Index Fund from BlackRock. Both track the same companies, follow the same benchmark, and move in almost perfect sync. But the difference lies in how efficiently they grow your money over time. Think of this as a race between two nearly identical supercars. Same track, same fuel, but slightly different engines. The question is, when you put $100,000 on the line, which one crosses the finish line with more? Let's start with Fidelity. Fidelity's S&P 500 Index Fund is built for one purpose: steady, long-term wealth creation. It doesn't try to beat the market, it mirrors it. That simplicity is its strength. It has an average annual return of 12.56%, a dividend yield of 1.16%, and a dividend CAGR of 7.01%. These small numbers, when compounded over decades, create massive results. If you invested $100,000 in Fidelity's fund today and reinvested every dividend, here's how that money is projected to grow. After 1 year, the portfolio would be worth $113,720. After 10 years, it would reach $353,817. In 20 years, it's projected to be around $1.2 million, and by year 30, that same $100,000 turns into $4,049,650. That's nearly $3.95 million in added value, with around $108,000 coming from reinvested dividends and the rest from capital appreciation. Now let's look at BlackRock's iShares S&P 500 Index Fund. This fund is a favorite among institutional investors in large portfolios. It has an average annual return of 12.4%, a dividend yield of 1.18%, and a dividend CAGR of 7.9%. Like Fidelity, it tracks the S&P 500 closely, but it does so with its own cost structure and trading efficiency. Under the same conditions, $100,000 invested, dividends reinvested, no withdrawals, here's how it performs. After 1 year, it's projected to reach $113,580. After 10 years, $350,660. After 20 years, $1,191,448. And by year 30, that same investment would grow to $3,968,241. That's a total value added of $3,868,241, with about $135,229 from reinvested dividends and the rest from capital appreciation. The two funds move almost identically, but Fidelity edges out BlackRock by a small margin, mainly due to slightly better compounding efficiency and lower costs. So for this category, Fidelity takes the win again. That brings the score to Fidelity 2, BlackRock 0. But the S&P 500 isn't the whole story. What if you want exposure to everything in the U.S. market, from large caps to small startups? I'll show you that in a couple of minutes, and in the end, I'll show you which one wins across the 7 categories and which one could leave you with more than $3 million extra in your portfolio. But first, let's compare the fees and costs. Let's start with BlackRock. BlackRock's fee structure works on a tiered system. The more you invest, the lower your rate. It sounds reasonable, but for smaller investors, it can add up quickly. Their wrap fees can start as high as 2.5% for portfolios under $500,000. That means if you invested $100,000, you could be paying $2,500 a year just in management costs. For their separately managed accounts, fees typically range between 0.1 and 1.5% depending on the strategy, whether it's equity, fixed income, or multi-strategy. Large institutional clients can negotiate custom terms, but for the average investor, it's often on the pricier side. And that's the thing about BlackRock. Its scale and sophistication make it incredibly powerful, but also more tailored to big players. It's built for pension funds, endowments, and institutions, not necessarily the everyday investor trying to maximize every dollar. Now, Fidelity takes a different approach. Fidelity's fee model is designed for accessibility, giving regular investors as much value as possible. Their Fidelity Go robo-advisor platform, for example, charges no fee for portfolios under $25,000 and only 0.35% once you go above that. Move up to their personalized planning and advice service, and the fee is still just 0.5% annually. Even at the top level, wealth management and private wealth services, fees range between 0.2 and 1.04%, depending on portfolio size and complexity. In other words, whether you're investing $10,000 or $10 million, Fidelity makes sure your fees scale fairly with your goals, not your net worth. So in this category, Fidelity takes another win. It keeps costs low, scales fees fairly, and prioritizes accessibility, a combination that helps investors keep more of what they earn. That brings the score to Fidelity 3, BlackRock 0. So we've now seen how the S&P 500 comparison went, but let's zoom out now, beyond just the S&P 500, and explore the entire U.S. stock market. Every company, every size, every opportunity. This category is all about total market index funds, which give you exposure to everything, large cap, mid cap, and small cap companies all in one basket. It's the simplest way to own a piece of the entire American economy. Here, I'm comparing BlackRock's iShares Total U.S. Stock Market Index Fund Class K against the Fidelity Total Market Index Fund. Both aim to do the same thing, capture the performance of the whole market, but their results tell an interesting story. Let's start with BlackRock. BlackRock's Total Market Fund is built for scale and precision, a favorite among institutions that want complete market coverage with minimal tracking error. It delivers an average annual return of about 12.17%, a dividend yield of 1.18%, and a dividend CAGR of 11.61%. If you invested $100,000 and reinvested every dividend, here's how your portfolio would grow. After 1 year, it's projected to be around $113,350. After 10 years, $349,215. After 20 years, $1,212,764. And after 30 years, that $100,000 becomes $4,189,683. That's a total value added of $4,089,683, with $322,682 coming from reinvested dividends and $3,767,002 from capital appreciation. Now let's look at Fidelity. Fidelity's Total Market Index Fund follows the same concept, but focuses on accessibility and cost efficiency. It offers an average annual return of 12.03%, a dividend yield of 0.93%, and a dividend CAGR of 5.35%. If you invested $100,000 here and reinvested every dividend, here's how that would play out. After 1 year, the portfolio grows to $112,960. After 10 years, $331,279. After 20 years, $1,064,163, and after 30 years, that same investment becomes $3,365,924. That's a total value added of $3,265,924, with $62,013 from reinvested dividends and $3,203,912 from capital appreciation. When you compare the two, BlackRock's portfolio finishes at $4.19 million, while Fidelity's comes in at $3.36 million, a difference of about $823,759. That gap may not sound huge in percentages, but in dollars, it's the difference between solid growth and standout performance. So in this category, BlackRock takes the win. Its slightly higher yield, faster compounding, and stronger long-term growth give it the edge. That brings the score to Fidelity 3, BlackRock 1. But returns aren't everything, because in investing, what matters just as much as growth is how well you handle risk. So in the next category, I'm putting these two to the test under pressure. BlackRock's approach to risk is all about quantitative precision. They rely on Aladdin, their proprietary risk engine, which analyzes trillions of data points every day. It simulates how market shocks, interest rate changes, and global events might affect portfolios in real time. That technology gives BlackRock a serious edge in managing volatility. The firm focuses on risk-adjusted returns, meaning they don't just chase growth, they aim for growth that's consistent and predictable. On average, BlackRock's index funds have a beta slightly below 1, which means they tend to move a little less than the overall market. For investors who prefer stability and fewer roller coaster moments, that's a major plus. Now, Fidelity takes a more tactical approach. Fidelity's focus on active management means they're not afraid to lean into sectors or themes they believe will outperform. That flexibility can lead to higher highs during bull markets, but also sharper dips when markets fall. Fidelity's funds usually carry a beta slightly above 1, signaling just a bit more volatility than the market average. For investors who don't mind a bumpier ride in exchange for a shot at higher returns, that's not necessarily a weakness, it's part of the strategy. So in this category, BlackRock takes the win, but just barely. Its data-driven risk models, steady volatility control, and disciplined management make it the more stable long-term choice for conservative or moderate investors. That brings the score to Fidelity 3, BlackRock 2. It's a close race now, and the next category could tie it all up. And for this category, we're covering the market segment known as mid-cap companies. This round is all about striking the perfect balance. Large caps offer stability, small caps offer explosive potential, but mid caps, they sit right in the sweet spot, big enough to be established yet small enough to keep growing fast. So which firm captures this middle ground better? It's BlackRock's iShares Russell Mid-Cap Index Fund versus Fidelity's Mid-Cap Index Fund. Let's start with BlackRock. BlackRock's mid-cap fund focuses on discipline and diversification. It tracks the Russell Mid-Cap Index, covering hundreds of mid-sized U.S. companies with strong potential but less volatility than small caps. It delivers an average annual return of about 5.22%, a dividend yield averaging around 3%, and a dividend CAGR of 11.61%. If you invested $100,000 and reinvested every dividend, your portfolio would grow to $108,220 after 1 year, $242,113 after 10 years, and $799,918 after 20 years. Stretch it out to 30 years, and your initial $100,000 is projected to turn into $4,591,952, a total value added of $4,491,952, with $3,217,568 coming from reinvested dividends and $1,274,384 from capital appreciation. Now let's look at Fidelity. Fidelity's Mid-Cap Index Fund takes a faster, more adaptive approach. It tracks the Dow Jones U.S. Mid-Cap Index, targeting companies right on the verge of breaking into large-cap territory. It offers an average annual return of 7.86%, a dividend yield of 2.32%, and a dividend CAGR of 7.04%. If you invested $100,000 here, the portfolio would grow to $110,180 after 1 year, $261,652 after 10 years, and $673,707 after 20 years. By year 30, that same investment reaches $1,709,153, a total added value of $1,609,153, with $321,027 from reinvested dividends and $1,288,126 from capital appreciation. When you stack those results side by side, BlackRock's fund finishes at $4.59 million, while Fidelity's ends at $1.71 million, a difference of about $2.88 million in favor of BlackRock. That kind of gap can define a lifetime of compounding. With stronger long-term growth and higher income potential, BlackRock takes this category convincingly. It's the classic slow and steady wins the race outcome. Less flash, more consistency, and built for investors who value patience and predictable growth. So that brings the score to Fidelity 3, BlackRock 3. And just like that, we're tied 3 categories each, which means it all comes down to the final one. Not numbers, not returns, but something far more personal. The experience of being an investor. Let's talk customer support. BlackRock's customer support runs like a machine, efficient, organized, and global, with teams spread across continents. Their service model connects advisors, institutions, and even governments through advanced systems. You can reach them by phone, chat, or email, and for institutional clients, their response times are very impressive. But here's the thing. BlackRock's system is designed for institutions, not individuals. It's built for billion-dollar pension plans and massive portfolios, not your everyday investor with a few thousand or even a few $100,000 to manage. It's professional, yes, but it can feel distant. Now, Fidelity takes a completely different approach. Fidelity's customer support is personal. It's not just about solving problems, it's about understanding your goals. You're not left digging through an FAQ page. You get access to real human advisors, proactive check-ins, and personalized reviews that help you stay on track. And when the market gets shaky, Fidelity doesn't wait for you to call in a panic. They reach out, offering guidance and adjustments before small concerns turn into stress. Whether you're investing $5,000 or $5 million, the level of care feels the same, and that's rare. That personal touch is a big reason why Fidelity consistently ranks among the top in customer satisfaction surveys. So in this category, Fidelity takes another win and breaks the tie. Its service is human, responsive, and proactive, exactly what investors need when things get uncertain, giving Fidelity the final edge and the final score of Fidelity 4, BlackRock 3. So that wraps up our 7 categories, but the big question still remains. When you put it all together, who's the real winner? After 7 categories of data, dividends, and strategy, it's time to show who truly comes out on top. Again, the final score was Fidelity 4, BlackRock 3. By categories, Fidelity takes the overall win, outperforming in fees, accessibility, customer experience, and long-term consistency. On average, those wins translated to about a 0.3 to 0.5% yearly cost advantage and an extra $2,000 saved per $100,000 portfolio every single year. But here's the twist: when it comes to pure dollar performance, BlackRock actually comes out ahead. Across 30 years, its funds generated roughly $3.63 million more in total portfolio value compared to Fidelity's, thanks mostly to the total market and mid-cap strategies where its compounding engine really outpaced its counterparts. Fidelity's S&P 500 fund still held a narrow edge, about $81,000 more after 30 years, but BlackRock's broader funds blew past it, adding millions in extra growth. So in short, Fidelity wins on rounds, but BlackRock wins in returns. And that's what makes this comparison so fascinating. They're both incredible, but in completely different ways. If you want a set-it-and-forget-it experience with global strength behind it, BlackRock may be your best ally. But if you value flexibility, low costs, and a personal touch, Fidelity is your clear winner. Want more value? Click the video on the screen to find the best index fund that can turn a $100,000 investment into a $12 million portfolio.